Welcome, bankers, to the Bankers Business Update. What to expect when you're expecting the 2020 financial reporting from businesses. This is Sachs, Todd Polinak, and you are hearing this live from our homes. Yes, this presentation is powered by Sachs, sacsllp.com, Sachs Wealth Advisors, that's sacswa.com, and S2 Solutions, s2solutions.tech, which is our new joint venture with Safari Solutions. I want to welcome everyone this morning. It's a beautiful December morning, and we have some great things to share with you. Unfortunately, bankers, no, there is no coffee, and you're not going to be able to stand in line for that crispy bacon or the beautiful French toast we normally serve, but we still have some really good information to tell you today, so stick around. Yes, this webinar, as we always like to tell folks, is for general guidance only and does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. So, pointing this out to you two bankers, that if you have any specific questions, you should consult a professional advisor. And of course, we are here for you. So hopefully you will call us. Here's our lovely panel of presenters today. Todd, myself, Josh, and Steve, my partners. And yes, we have not changed one bit. We are still wearing the same clothes from the last time we presented. Today's agenda. We're going through the introduction right now. The focus really is on financial reporting and taxes, what to expect when you're expecting at the end of the year from your customers. We're going to talk about financial statement considerations, the Paycheck Protection Program loans. How are they going to appear on your financial statements? Going concern implications. That is a nasty word, but going concern is a good thing. If you don't have a going concern, that's a bad thing, but Josh is going to speak about that. Impairment issues, something that we haven't seen in a long time. Lease concessions and debt waivers. My partner Steve is going to talk about the tax considerations, the Paycheck Protection Program loans, the Biden tax plan proposed, and year-end tax planning. And then finally, we're going to get together, Josh, Steve, and myself, and we're going to talk about some things that perhaps we have on our mind. Now, folks, we have asked you to provide some questions in advance, and we also are inviting you during this session, if you have a question, to submit it. But just want to let you know that we will be answering those questions you submit after the webinar. We'll be sending out an e-blast or an individual email addressed to you with those answers. Hey, look, we're here to help, so ask some questions. I want to turn this over now to my partner, Josh, to kick this off on some financial statement considerations. Josh, tell us about all these wonderful things the bankers want to hear, starting off with PPP. Josh?
Sure, Todd. Yeah, thank you, buddy. Good morning, everybody. As Todd said in the beginning, we really wanted to bring to the forefront for you folks, some of the unique things in our world that, it's very possible that you will see, especially as you start to get financial information from your customers, as you go through the loan closing process. I mean, the renewal process is next year. So the first one is not a new thing. You're all, I'm sure, very familiar and sick of to this point, just as much as we are, but hey, it's something we need to deal with. So we're going to talk about PPP and what the implications are to the financial statements. So I will say this, there are two options. We're going to go through, what those are, but know that there could be different treatment for financial statements and for tax returns. And as Todd mentioned before, Steve is going to go through that later in the presentation. So I'll just say this before we get into the two options. Although the legal form of the PPP loan is debt, there's some people who believe that the loan is in substance a government. So like I said, we'll talk through those two things. And the other important thing is there must be clear and descriptive disclosures in the financial statements, including the policy selected and the related impact. So let's go to the next slide. So the first one is it's accounted for debt. There is an accounting standards codification rule number 470 with respect to the loan, and under this standard, it's treated similar to your normal debt, right? Where you would accrue interest, it would remain liability on the balance sheet until either the loan is in part or wholly forgiven, and the debtor has been legally released, right? So we've started to see the SBA, on some of the loans that have gone all the way up and through the process, they've issued a letter that says that the client has been forgiven, not forgiven. So that is what creates that legally released, or the debtor pays off the loan to the creditor. And I think it'll be interesting to see, especially in light of the loan necessity questionnaire and still some of the unknown and the challenges surrounding what an actual SBA audit will entail, as to whether or not companies will actually make the business decision just to repay the loan. But again, this is more of a timing thing. So once the loan is in part or wholly forgiven and the legal release is received, a non-governmental entity would reduce the liability and record a gain on extinguishment. So you'll most likely see this as other income. You may actually see it called gain on extinguishment in the financial statements themselves. So option one is to treat it as you would treat any other loan, as a liability. And again, in the event that the loan is partially or all forgiven, that piece would be reflected as income for the current year. The other option, which is under international accounting standard number 20, says that it's a conditional government grant. So if an entity expects with some certainty to meet the criteria for loan forgiveness, the loan may be accounted for as a government grant with a condition. So in this case, you would, at the onset, the business would have recorded the cash inflow and the loan is deferred income, and then as the money was spent, they would recognize it as income at that time. So similar to those of you who work in the nonprofit world, essentially as a cost reimbursement contract. So in this case, being that the covered period for all loans has, for the most part, I would think expired, unless you were one of the really, really last people to get a loan. At this point, all of the loan money has been spent, and it is possible that some folks will take the position of recording it as revenue. And again, as I mentioned before, Steve will discuss later on the tax treatment, but this would be more consistent with the proposed IRS tax treatment as well. So again, just something to be cognizant of. Certainly, if I'm a business and I know I'm close to the covenants and I need the additional income, then I would think you're going to see more folks put forward this presentation in lieu of the more conservative approach, as we mentioned before. So again, PPP could be on the balance sheet as a traditional loan, or in this case, it could be reflected as income consistent with the spend down. Okay. Going concern. Now, just to clarify, a company that is reported as continuing as a going concern is a good thing. It's companies who are deemed not to be continuing as a going concern as ones that you need to be you really need to be more cognizant of. So again, this is something we know a lot of customers. We have clients, I'm sure you have clients as well, who were really hit hard because of the pandemic and may still continue to be hit hard really until this turns around. We look at the hospitality industry as one that has really suffered. The food and beverage industry, restaurants, things of that nature, are all really struggling. So Going concern is now part of both the auditing and accounting standards. This is not new. It's not just specific to audits. It's possible if you have reviewed statements that you will see this as well. There is a there is an accounting standards update 2014-15, which requires management, in addition to the auditor, to evaluate going concern. For those of you who like to read the rules, accounting standard ASC 205-40 is the full standard with respect to going concern. And the measurement period, so the evaluation is the ability to continue as a going concern within 1 year after the date the financial statements are issued or available to be issued. So many years ago, people used to look at going concern as 1 year from the balance sheet date. So if you were evaluated on December 31st, 2020, you would look forward a year to December 31st, 2021 to determine whether or not the company would still be in business. Now it's different. So either let's use the same. So I'm a December 31st, 2020 year end. My financial statements are issued on March 31st, 2021. I'm looking a year out from March 31st, 2020 to 2021. So it extends the period. It creates a larger look forward period. And again, this is really designed to be more transparent and forward looking and see whether or not the company will in fact continue to be in business. Okay. So if substantial doubt is raised, okay, and it is alleviated by management's plans, then the company would disclose the following. So the principal conditions or events that raise substantial doubt before the consideration of management's plans, right? So in the example I gave before about the hospitality industry, right? So people aren't and if we use hotels specifically, people aren't traveling, people aren't staying in hotels. There are ordinances in place that limit the amount of people who can be in the hotel, occupy rooms at any given time. Those are conditions that could raise substantial doubt. Then you have management's evaluation of the significance or conditions or the events, their plans that alleviate this substantial doubt. So what are they doing? They could certainly monitor, a lot of times people are monitoring expenses. They would cut payroll. They would try to find ways to renegotiate leases or rents or things of that nature in efforts to free up cash to be able to support themselves during these tough times. And how it's presented, well, it can be done as a liquidity or a financial condition paragraph after note 1 to the financial statement. So this is only a footnote disclosure. However, if substantial doubt is not alleviated by management's plans, then the following would be included. So statement indicating there's substantial doubt about the company's ability to continue as a going concern. Similar to the above, the principal conditions or events that raise substantial doubt, management's evaluation of the significance of the conditions or events. Still they want to put in there what their plans are to mitigate the substantial doubt. And there is a going concern other matters paragraph that's included in the actual audit report that references the footnote disclosure for the bullets mentioned above. So this is a serious thing. Certainly a company does not want to have this in their financial statements because a lot of times it does indicate a doomsday possible scenario. But look, we've certainly worked with clients. We've seen financial statements where people are treated as a going concern, as not continuing as a going concern, and they turn things around and they get out of it. But again, I would expect a lot of pushback, and from a bank's perspective, I certainly think even seeing an evaluation of going concern in the footnotes would certainly be a red flag, that things maybe are not as good, as they seem. Okay. So that's going concern. Again, it is a much more serious topic than the couple minutes we just spent on it. But certainly, as Todd mentioned, send questions if you want to know more about it. But again, this was really designed to bring things to your attention that you may see this year. So Todd, I'm going to turn it to you to talk about impairment.
Thank you, Josh. So impairment, this is something that we haven't seen a lot of in the past, but with COVID-19, with the shutdown of businesses, with all the craziness that's taking place in the world, this is something as bankers I think you need to be aware of. We're talking about long-lived assets. We're talking about those non-current assets, those long-term assets, those assets that are expected to provide economic benefits over a future period of time. So the assets, as you know, under GAAP are recorded at historical cost. And you typically, with fixed assets, you're going to amortize them, you're going to depreciate them. But did you know that there could be a possibility that you may be writing down those assets if there's an impairment? So this is a highly technical section, but we wanted to bring it to your attention. Let's talk a little bit about impairment. So first we have triggers. There's a few different triggers, and this is actually in the ASU standard. First, so think this way, bankers. Think in terms of your clients that either have groups of different assets. Maybe it's a division of the company. It could be a specific asset. It could even be goodwill. So here are the different triggers. First, there could be supply chain triggers, store closures, shutdowns, slowed production and or raw materials affected by COVID-19 that just aren't available. That's one trigger. The other trigger is company-specific financial triggers. Think in terms, again, of pools of assets, of divisions of a company, earnings consistently below forecasted levels, lower than expected earnings, continuing net losses and or cash flow losses. That could be a company-specific financial trigger. There could be market triggers when you're looking at these assets. Decline in market or industry, reduction in stock price and or workforce shortages due to government-imposed restrictions. And of course, there's other triggers. The one area could be competitors that have recognized an impairment loss, and you have something similar on your balance sheet. Well, that could be a trigger too. So there are impairment issues that are triggers. And the next is that you need to consider where to look. So you first look at companies' inventory and AR. Is there an impairment? Second would be your long-lived assets, your fixed assets and definite-lived intangibles. The third, indefinite-lived intangibles. And fourth, goodwill. Now, according to ASU 360-10, and anyone who dares to read it, God bless you, there's 3 different steps in the process. First, you're to identify the indicators of impairment, i.e. the triggering event we just went through. Your next step is to perform the recoverability test. So you're identifying the asset group, you're estimating the future undiscounted cash flows, and then you're comparing it to the carrying value. Remember, typically the carrying value is going to be historical cost. And the step 3 is to measure and allocate impairment loss and estimate fair value of the asset group and compare this to the carrying value and allocate any impairment to individual assets. So this is a write down of those assets. So that's impairment. Hopefully you don't see too many of your clients that have impairments that are writing down their assets, especially if you have those assets as collateral. So let's talk about the next exciting topic, lease concessions. So because of COVID-19 and the pandemic, there have been situations where lessees are going to the lessors and asking for some type of concession. So the good old FASB, the Financial Accounting Standards Board, in April 2020 issued a Q of A on accounting for lease concessions for COVID-19 related lease concessions. And this is if lessors are granting payment forgiveness and the payment deferrals as lease concessions to the lessees, and the primary concern was how should these lease concessions be accounted for, because it's kind of a unique time, right? So not typically do you have lease concessions, at least to this magnitude. So in this Q of A, they came out with the answer and they said this, ready? They said, if the concessions are COVID-19 related and the concessions do not result in a substantial increase to the rights of the lessor or the obligations to the lessee, the entities may elect on a lease by lease basis, lease by lease, to treat the concessions as either as if the concession existed in the original contract or as a lease modification under ASC 842 or ASC 840. So what does that mean in plain English? So in the first situation, you're basically adjusting the lease according to its original contract as if the concession existed in the original lease. But if it's a lease modification, then you have to treat this as a brand new lease. So for practical purposes, most people are going to choose option A, so they don't have to record a brand new lease. In both cases, you're going to see, obviously, a decrease in your lease expense over the period of the lease. So that's something just to know. You may see some changes in the way your leases are reported in 2020, thanks to COVID-19 and the FASB. Another thing that we have in common, debt waivers. Yes, bankers, we are usually telling our clients to request debt waivers when they break a covenant, because it does have a negative ramification on their financial statements. And let's talk about that. So the current economic environment necessitates a refresher on whether debt should be classified as current or non-current, especially if a debt covenant is violated. And obviously, most people want their debt to be shown as non-current, right? Not as current, kind of shows you got a problem. So as of now, FASB is deliberating a brand new ASU on debt, which may change to current guidance, but for now, this is it. In general, if a violation of a debt covenant gives the lender the right to call the debt as of the balance sheet date, the borrower must classify that debt as current unless the lender waives its right to call the debt for a period of greater than 1 year, a year and a day, in which case the debt is deemed non-current. Next slide. So a borrower has a loan with debt covenants that it must meet on a quarterly basis. If the borrower is in compliance as of 12/31, 2000, I guess is the case here, but knows it won't be at March 31st, 2001, the loan must be classified as current. So the point is that if you know as of 12/31 that you're going to be in violation of that debt covenant, then you must obviously classify it as current. Now the next one is a borrower has a long-term loan with quarterly covenant requirements. It is in violation of its debt covenant as of 12/31/2000 and receives a waiver to call the debt for a year and a day. The lender retains its right to act on covenant violations that occur on future compliance dates. It is not probable that the borrower will be able to comply with the debt covenants by March 31st, 2001, but will be able to comply with the remaining compliance dates within the waiver period. So that's the future periods, but it's not going to be in compliance with March 31st, 2001. Is the loan current or non-current? And the answer is the loan would be classified as current because the borrower must be able to comply with all covenants for each measurement date. So I am going to turn this over to Steve to talk about the next exciting topic, which is tax implication.
Thank you, Todd. Thank you, Josh, too, for that presentation. So I'm going to, as Todd had discussed, I'm going to discuss the PPP loan tax implications, and notably the ability to deduct those expenses. This has been something that's been on the minds of borrowers basically since the PPP was released all the way back, if you can believe it, in March. It's hard to believe that so much time has passed, but the IRS put out a notice shortly thereafter indicating that the expenses associated with the forgiven loan proceeds are not deductible for tax purposes, which essentially eliminates some of the benefit that taxpayers would be able to take, because while the income is tax-free, they also don't get the benefit of the deduction on their tax returns. There is a bill that's been in front of the Senate since May, has bipartisan support, that basically indicates that the intent of this program was to make the expenditures deductible, but the IRS is saying, look, if you want to do this, Congress, you need to act and release this legislation, but it has not passed yet. But as it says here, it does have bipartisan support, so we're hoping that at some point it does get included, be it in the Senate or the governmental funding bill. The government is essentially shut down if they don't pass a funding bill by December 11th, but it doesn't look like that's in that legislation right now, but we'll see what happens. So just last month, the IRS put out a new notice, basically, or two notices, essentially doubling down on their position. What we had thought was that for tax purposes, and this is different from the discussion Josh had earlier in terms of the treatment for book. There can be book tax differences, not just in this scenario, but in others as well. But we had thought that where borrowers who still had a loan as of the end of the year, then it would be just that, a loan in 2020. And when and if forgiveness was received, presumably in 2021, at that point, they would have either an expense recovery or income in 2021. So essentially you take a deduction in 2020 and then pick up the income in 2021. However, they basically, as I said, double down and are saying if you have a reasonable expectation to anticipate loan forgiveness and you're in this overlapping year scenario, you essentially don't deduct the expenses in 2020. While reasonable expectation is not specifically defined, we do think it will basically mean that if you're planning to apply for forgiveness, then you do have a reasonable expectation to receive it. The Rev Proc here talks about a safe harbor for taxpayers to deduct PPP expenses, but that's if their loan forgiveness request is denied or they withdraw the application for forgiveness, at which point it basically does become a loan. So again, this is a very hot topic. It's impacting the cash flow of our clients now as we plan for fourth quarter estimates, be those due December 15th, January 15th, as well as potentially March 15th and April 15th filings for the following year. So this is something we're extremely focused on, and again, hope this is decided in a favorable sense, especially if you think about the fact that there's another wave of COVID, if the first wave even ever ended, but it's certainly, we've seen an uptick, and borrowers presumably are going to need more money, more stimulus, more help in essence to pay their taxes, or else they'll need to reach out to the government to get more stimulus. So this really is just a natural way to build in additional benefit for taxpayers, for borrowers, but again, we'll see what happens. So moving on to the next slide, we've seen, and this is also something, there's a lot of moving parts. I've been calling it a whack-a-mole, in that if you think you've knocked down one piece, another piece kind of pops up, and we've seen with the potential transition of the White House, we know that the current administration is still battling that, but assuming Biden does become president, the ability to pass these laws, these were part of his proposal while he was running, but we've seen the Georgia Senate runoff that will occur in January is going to have a significant impact on whether or not this type of legislation can be passed. But we're going to include some information here just to keep in mind, should there be changes in the tax law for the upcoming year. The first one, Biden is talking about increasing the top tax rate from 37 to 39.6%, and he's saying that that would impact taxpayers only earning more than $400,000. Now, is that on a per spouse or per person basis for those borrowers who file jointly? How is it impacted? Is it taxable income? Is it just the gross income? We don't know, but something to keep in mind on a potential increase in tax rates. The next slide discusses specifically capital gains. The current rate is 20% plus the 3.8% net investment income tax for certain borrowers. And essentially borrowers in a lower rate, lower brackets right now pay either 0 or 15% as opposed to the top rate of 20%. And also the carried interests. If the 3-year holding period is met, they're taxed at long-term capital gains rates. While Biden is talking about increasing, essentially making the capital gains taxed at ordinary rates for taxpayers with income exceeding 1 million. And we don't know if that will be, well, will the first million be at 20% and on top of that be at 39.6%? So a lot of information to still digest here, and we'll see. Again, just because this is proposed doesn't mean it will pass in its final format. I think even if the Senate runoff in Georgia does go all Democrat, it doesn't necessarily mean that these provisions will just pass with flying colors. I think these increases, significant increases in capital gains rates will meet with pushback, but again, I don't know. So that's just my personal opinion. Don't hold me to it if it does change. But other items here, we believe the 3.8% net investment income tax will remain, but they are talking about eliminating the preferential rate benefit on carried interest, essentially taxing those all at ordinary rates would be a significant impact for private investment, private equity, and whatnot. So this is something that we've been planning a lot. Our estate and gift team, as well as probably a lot of the attorneys that you work with, are, I'm sure, neck deep in planning under the guise that the lifetime exemption, which is currently $11.58 million per taxpayer, could be reduced to $3.5 million. Did I say percent? 11.58 million could go down to 3.5 million, and that obviously would have a significant impact. But if you get your gifting and your estate planning done now, there wouldn't be a sort of a clawback of that benefit. The basis step up. So basically, when people pass away, their assets get a step up in basis to fair market value. They're talking about eliminating that as well, and how that would be done is extremely complicated. And until this actually happens, it's probably not worth discussing at this point. But certainly something to keep in mind. Increasing the estate rate to 45% from 40%, so that would have an impact as well. And then the current law basically allows any person to make an annual gift of $15,000 to as many people as you'd like without having to file a gift return. So Josh and Todd are very generous. They've actually both already sent me $15,000. I haven't received it yet. They told me that they both sent me $15,000, and their spouses can send me $15,000 as well. So that's certainly a nice gift that I'm going to be checking my mailbox for. But they're talking about now changing that from a per donee limit to a per donor limit. So you can only gift annually $50,000. So that would obviously have an impact on people who try to give multiple gifts throughout the year. Next slide. This is specifically with regards to itemized deductions. There was a limitation that was eliminated as part of the Tax Cuts and Jobs Act. So taxpayers are now essentially don't face a limitation other than on state and local taxes associated with their itemized deductions on their tax returns. This is your mortgage interest, your charity investment interest, items like that. Now, for taxpayers under Biden's plan, for taxpayers with income exceeding $400,000, they're talking about capping those itemized deductions at 28%. So that's something to look at, and also, though, possibly eliminating the state and local cap that's mentioned right there, getting rid of the $10,000 limitation. This has really been something, also a hot button issue, because taxpayers in high tax states essentially New York, New Jersey, the Californias of the world, others as well, are not allowed a benefit to deduct those state taxes. So they may get rid of that in the plan, but it's something that we're monitoring as well. On the next slide, this is about QBI, the Qualified Business Income Deduction, which was also part of the Tax Cuts and Jobs Act. It essentially allows pass-through entities to sole proprietorships as well to deduct, to basically take 20% off the income, depending upon certain types of income, what business you're in and whatnot, wage, asset thresholds, depending upon your level of income. Well, the Biden plan is talking about eliminating this deductions for taxpayers with income exceeding, again, 400,000. 400,000 is this kind of magical number, but they're talking about getting rid of that as well, and then also potentially limiting this for real estate investors because they consider those potentially passive. There's talk about limiting 1031 as well. That's not mentioned here, but like-kind exchanges, even putting some limitations on that as well. So we don't know, again, if any of this will pass, but we can see the theme here of increasing tax rates and increasing tax on what Biden is so-called wealthy, essentially someone with income over 400,000. So something to keep in mind. Okay, the next slide here, the corporate tax rate currently is 21%. The Biden plan talks about increasing that to 28%, and then a minimum tax of 15% on corporations with book income, not taxable income, book income of 100 million or more. So it's kind of structured as it says here as an AMT, but again, we'll see if this even passes and how they would calculate that. And again, to keep income here in the U.S., there would be an offshoring penalty of 10% on the tax. So it would be 10% of 28% if you're offshoring. So you're talking about a potential 30.8% effective rate on certain corporate income. The next slide talks about tax depreciation, bonus depreciation. So currently, and there doesn't look to be any thoughts on eliminating this, but taxpayers are allowed a full write-off of the fixed assets they put into service, provided they meet certain thresholds. And here on the flip side, if it is work done in America, there was a 10% tax credit, so that would reduce corporate rates as well. And I think I passed over this on one of the slides, but there also is talk about the Social Security and Medicare, the FICA taxes. So right now, the Social Security is only taxed on income up to $137,000. I think for 2021, it goes up to around $142,000 or so. They're talking about for borrowers with income of 400,000 or more, also putting an additional payroll tax threshold responsibility on them, another 6.2% that would fall to the employee side. So again, something to keep in mind as well. I think I glossed over that on a prior slide. Moving on to the next one. We just have some year-end reminders and thoughts. As we were saying, the estate and gift planning is something that's very hot right now. We're hoping, if they haven't started yet, they're probably not going to get into a lot of advanced planning techniques, but at least they can do some basics. So definitely reach out, encourage them to reach out to us, to their attorneys, to their advisors, to really make sure, especially the wealthier borrowers, that they have good estate and gift planning in context or in mind, or at least they've been hopefully doing this throughout the year. One of the things we've also seen, and I think this has impacted you as bankers, the change in control. So if borrowers go through certain asset or stock sales, interest sales, then the PPP loans either need to be escrowed or the forgiveness process needs to be completed depending upon the type of transaction. So that's something we've seen to some degree, but I'm sure it's impacted you all much more. Other items we're recommending to clients to review portfolios to see if any unrealized losses can offset capital gains. And again, this is something to keep in mind as we try to kind of thread a needle here, because if the capital gain rate goes up next year, then it may make sense to hold on to some of those losses to next year. But again, there's just a lot to consider. So it really is not a one size fits all scenario here. Charitable contributions basis in your pass-through entity to see if you need to contribute more to free up some losses. But again, this goes back to whether or not tax rates goes up. And as I say, whack-a-mole, where okay, now I've put more money in, I got a deduction in 2020, but did I really want to take that in 2021? Hard to say. At this point, again, each scenario and each situation needs to be looked at separately. And lastly, just timing of deductions, timing of when you want to recognize income and expenses, something that we do every year. So that completes it. Now we're going to go through final thoughts. I'll give mine first. Mine will be viewed through a tax lens. First of all, I'm very hopeful that there's bipartisan support and get these PPP expenses deducted. I think the whole point of this was to keep companies working, keep people employed. So getting some benefit to the companies so that they don't have to get additional stimulus, which essentially would come for the government by allowing these expenses to be deductible. We're really hoping that comes to fruition. Secondly, we're hoping that the comment period associated with the loan necessity questionnaire, we're hoping to see that gets softened a little bit. Just in general, I know, thinking about it from a top level, that borrowers are struggling. It's difficult times out there. A lot of small businesses have been shuttered. So we're hoping that they soften these rules a little bit to allow small businesses and the people that work there, and really all businesses, to be able to kind of fight through this pandemic, and we'll really see what happens. But it's just hopeful, at least from a tax perspective and from a PPP perspective, that some of these rules are softened so that borrowers can continue fighting through this. So those are my final thoughts. I'll turn it over to Todd, Josh, whoever wants to go next.
You go, Josh.
Okay, so my thought is, we threw a lot of stuff at you. There's really a tremendous amount of things to consider as you go. This will be a year that's unique, that hopefully we never experience any again. But there's a lot of things to consider. I think, from your standpoint, you probably have a good handle as to how your clients are doing financially, but there's a lot of interplay here into things at the end of the year between, as we talked about, going concern, impairment, how you account for the PPP loan, in addition to all the different types of tax planning potentially that Steve laid out. So again, if you haven't spoken to clients, there's certainly a lot of things out there, a lot of information that you can provide to create certainly a lot of value. Again, hopefully they're working on all these things, but if they're not, there's certainly a lot of potential there. And the other thing I always say is, you see how important it is, especially in a time like this, to really have the right team around you, whether it be from an accounting standpoint, a banking standpoint, a legal standpoint, because without a real solid team, there were so many challenges this year, but without having that team attached to you, it would be even harder. And just want to say, certainly we're here for you guys and girls, and if you have questions, and if you need to bring us into certain situations, don't hesitate. I think the three of us on this call have spent a tremendous amount of time with respect to PPP. You've probably heard our voices weekly, so we get it, we know it, and if people are struggling with it, certainly let us know. And Todd, I'll give it to you to wrap it up.
Hey, thanks, Josh and Steve. So my final thought, it relates to what I would call a smart, good business practice. And I was reading a book by an author by the name of Joe Gerard, and he was talking about the 250 rule. The 250 rule basically is that anybody has at least 250 people that they are pretty close to, and therefore can influence. And I want you to think about your customers. I want you to think about your COIs. There's about 250 of them. And it works both ways, as you know from your experience, bankers. You tick people off, that's 250, tick one person off, that's 250 people that could hear some bad news about you. But if you really super please one person, there's an opportunity for 250 people to sing your praises. So with that, I mean, there's an old commercial, and we don't watch commercials anymore because everything right now is commercial free, thank God. But there was one that was called Reach Out and Touch Someone. It was an AT&T commercial. And I'm just wondering, are you reaching out and touching your customers? When was the last time we talked? I think I want to leave that final thought, bankers. When was the last time you spoke to someone, a representative from Saks? When was the last time we spoke to you? And if it's been a while, let's get on the phone, let's get on the Zoom, and maybe even there might be a time we can have coffee, I'm not sure. But I think we need to end this in a positive note, that even though things seem to be difficult, we need each other, we need to stay connected. We are here for you. So closing it out, didn't see any questions come in. So if you bankers have any questions, or anyone else on the call, there's a COVID-19 website. That's our website, but also there's a COVID-19 at sacsllp.com. You can send us a question. I'll be happy to answer it. And let's talk. Reach out to either Steve or Josh, myself, or one of your Saks partners you deal with. We kind of miss you guys. It's been a little bit quiet out there. So with that, I'll bid you adieu, and thank you for listening to our Bankers Breakfast for 2020. Take care.